This is Start to Sold, and I'm Emily Page. Today, we will be talking about deciding when and how to sell your business. And I have industry experts here that we are interviewing from Mentor Securities. We have Davis Blaine and Eric Klein. Thank you guys for being here. Can you please introduce yourselves and tell people who you are?
Emily, thank you very much. Yes, I am Chairman and CEO of Mentor Securities, and our success is really dependent on having a complete transaction for our clients, whether we're involved in selling their business, helping them buy a business, or raising growth capital. Personally, I have 4 decades of experience working with companies on the buying or selling of their businesses. And I've worked with companies of all different sizes. I personally have experience in this field, having started 6 companies, acquired 1, and sold 4. So as a business owner, I really understand what you're going to go through, the emotions you're going to experience, and how you're going to feel about the process. And so we're going to spend our time today talking to you about the process so you can understand better what you're going to go through.
I'm Eric Klein. I have a 25-year history in investment banking and a business owner and operator of a variety of different businesses, and have reviewed and advised on many companies in a variety of industries.
So for everyone watching, these guys are experts. Basically, they've got years of experience. And so let's ask them, who is Mentor Securities and what types of services you offer so that people can understand why you're experts and why they should listen to the rest of this interview.
Okay, thank you, Emily. Well, Mentor Securities is an investment bank. We're actually a broker-dealer that is a FINRA broker-dealer. So the SEC is our monitoring body. So we have to report to the SEC, which makes us a lot more circumspect in the things that we do. We really have 3 different services. The first is the sell side, second is buy side, and the third is capital raise. On the sell side, we're pretty much industry agnostic. So we're experts in a lot of different industries, but we're not focused on 1 or 2 industries alone. We work with companies' revenues of roughly 15 million to up to 300 million. And we like a minimum of 3 million of EBITDA. That is on the sell side. On the buy side, we work with strategic buyers or private equity firms, whether we're buying for a new platform or an add-on to their current platform, let's say the private equity firms. So we will go and do targeted searches. But in both the buy side and the sell side, our fees are developed through 2 things. One, we're retained. So we have an upfront advisory fee. And secondly, we have a success fee. Now, the third service is capital raises. We're looking to companies that want to raise about 5 million and above. 50 would be nice too. It's a similar program where we're retained and then we get a success fee. We're looking for companies that have traction and they're looking for growth capital, either to grow their business or to make strategic acquisitions.
An executive summary for those of us who maybe don't have as much experience is that Mentor Securities helps businesses create a fair market valuation and prepare for sale and find buyers. So if you were, let's just pretend you owned a house, everyone understands what a real estate agent might be, but a real estate agent just helps you sell. So Mentor Securities does that, but they also can help you figure out how much it's worth, which, you want smart people on your side when you're trying to figure out how to get the best value for your business. So that's what Mentor Securities can provide for someone. So when is the right time to sell your business?
A seller should really think at least 2 years ahead of time to prepare for a sale. It's very important. And frankly, there are a lot of people, and I'm a firm believer in this, every day you should look at your business as if you're going to exit tomorrow. And when you do that, you will work on the things that make your business more valuable. Okay.
And another earmark that, people are looking for is obviously EBITDA. So people want to know whether or not the company is profitable. And they also might be looking for growth. So an earmark of a really great candidate for sale would be one that has profit and is growing. But you don't need to be growing if you have at least EBITDA and a very mature internal professionalized management team.
We typically like to see service businesses with a minimum of about 25% EBITDA margin. In a products business, I mean, if it's manufacturing, maybe we'll see 15%. If it's a service related business, we like to see high recurring revenues of at least 60%, whether it's subscription or contract revenue. What is really defined as a professionalized management team? They're running the business on a normalized basis, not as a lifestyle business. So that's really, really important. I know I personally have seen business owners where they're running QuickBooks and they're running their business and personal expenses and income through the same set of books. I see that a lot. The next point is clean set of books using corporate software like White Plains, NetSuite, SAP, and alike. If you can somehow minimize, we like to see, as an ideal candidate, we'd like to see low customer concentration. Some businesses can't get around government regulatory liabilities like healthcare services businesses. So, I mean, you really can't get around that, but you want to try to minimize those regulatory liabilities the best you can. I'm also stating the obvious, but no current or near-term litigation or employment matters. I mean, it's going to happen when it happens, So an ideal candidate for us is a company that's domiciled in North America. It's okay if they have operations or revenue from international locales, but we like to see companies that are domiciled in North America.
And any other comment about ownership of either intellectual property or because I think it's a fair thing that affects valuations and whether or not some companies
absolutely.
work towards that.
Ownership of IP is critical. If you think about it, probably 80% of a balance sheet of a private or public company is really made up of intellectual property. However, if you haven't acquired the intellectual property through an outright acquisition, that's never going to show up on your balance sheet. So that's one of the things as valuation experts that we look into because we value a lot of intellectual property.
Yes. And I'm even thinking of the product-based businesses that are watching. There's IP in the recipes, making sure that you're not just private labeling a product where you don't even know what you're making. Or if you don't own, ideally, if you own a factory, that is an asset that you guys would value. But if you don't own a factory, at least you have the processes in place, you own relationships. I mean, the amount of ownership is really important to be definable and measurable. So that way, when you're transferring it to someone who's not you, you're no longer working and employed at that company that you built, the person who owns it can still continue to run it.
Right. And use the IP. Yeah.
What is the evaluation process that Mentor Securities usually takes someone through when you're creating a valuation? I know you've got years of experience in valuation. So, what would be the step-by-step process you take someone through?
Well, and also like Eric, and I didn't mention it at the top, but I have started four or five companies and bought and sold several businesses. So we both have that operational experience and that understanding of how a business should function. And it's funny, every owner thinks their business is unique, and it is to a certain extent, but it's not, because there are certain principles that apply to every business. So when we're looking at your question here, looking at the evaluation process, I think probably the single most important thing we do is to try to find problems, because if we don't find them and we bring in buyers, they're going to find them. Okay. So what we want to do is find the issues, the good and the bad, and then try to have answers or resolutions for the problems. Like Eric mentioned, maybe customer concentration. Maybe there's a way that's not really, shouldn't be looked at as customer concentration. Okay. Maybe it's an industry that's smaller and doesn't have a lot of customers. So you want to emphasize that rather than the fact that they only have 5 or 6 customers. Okay. So we're looking for issues, but we're really as part of the initial process, that advisory fee or the retained fee, we're trying to determine what this company should sell for. So we're going through a process of discounted cash flows. We're looking at various multiples, what other companies that are similar to our seller have sold for. And Eric mentioned there's two parameters there, and software companies really sell as a percentage of revenues or a multiple of revenues. So there's multiples of revenues and multiples of EBITDA. So we're putting together the analytics where we can come up with a good, strong range of what that company should sell for. And then part of that process is to go back to the seller and make sure that we're aligned in our interests, make sure that what we think they're worth and what we think we can get in the marketplace is what they think. It's very critical, because if we go into a situation where they're thinking $100 and we're thinking $10, we have a major disconnect. So that's a critical component of what we do. I think also to look at this in terms of the ideal buyer, okay? We want to find the buyers who want to eliminate competition, who want to buy intellectual property and customers, who are looking for key personnel that will complement their operations. And so we're also looking for the strategic buyer who doesn't have strong organic growth. So what do they have to do? They have to go to the marketplace and acquire companies if they don't have that strong organic growth. The other thing, the ideal buyer is really, do they fit with our seller? Will they have a similar culture at the end of the day after they've signed off on all the documentations, and that owner or owners of the seller are no longer there, which could be 1 month or it could be 2 years.
I think anyone who is unfamiliar with this process would immediately know, well, it needs to be a profitable company. The average person can value something based on, revenue and profit because it just makes sense. But what you're also describing is something outside the scope of what most of us would consider would be the ideal candidate would pay more than someone else who's just evaluating it as an asset, meaning someone who requires something that adds value. Like, oh, I just bought this and now I own IP. So my current portfolio of a business A plus business B isn't just 1 + 1 = 2, it's 1 + 1 = 3, 1 + 1 = 5. And so you're describing this not checkers, but chess, that you are entering the intimate area of getting to know a company when you're doing evaluation, and you're helping the business owner to think from different vantage points. Who would find this company the most valuable so we can maximize, an estimated valuation? And I think that's a mind-blowing paradigm shift for the average person who maybe
it is a paradigm shift. And one other point I'll add to that that's very important is most of our sellers are concerned about identifying the fact that they're actually selling the company to their competitors. So we're very, very careful in selecting the buyers that we don't go to the competitors right away. But the interesting thing is we want those people on our list, because if we've gone through a whole series of other strategic buyers and private equity firms, a lot of times when they're really down the line in the process, they'll go to a competitor and sometimes get the best price. But we keep them in abeyance, if you will. And we don't want them to know until we're down the line, because they can harm our sellers, right?
There's a lot of different investment banks and M&A companies out there. So this is a similar process you would go through with anyone. We're talking to Mentor Securities and so they can give us their worldview. But if you are a company owner and you wanted to get this type of service, you wanted a valuation, you would hire a company like Mentor Securities, and you'd sign a contract. They would give you a quote for a fee, and you'd have to then reveal everything. You'd have to share your bank statements. It's a rigorous thing. And Davis, is there anything else you wanted to add when it comes to this process that you should kind of prepare the owner for? Like, how long does it take to do evaluation? What else do they need to give you?
Well, you're right. We need the clean and the dirty laundry. We need everything, really. We need them to be as truthful as they will be with us. What's interesting, I think, about Mentor Securities, we also have a sister company called the Mentor Group, which is a full service valuation firm. We don't sell businesses in the Mentor Group, but we value hundreds of business entities, intellectual property, real estate, and equipment. And so our people are very well versed in how to put values on a business and how to explain that to the sellers. So I think it gives us an edge in the marketplace. Yeah.
The process is how long, like they would reach out to you for a quote, you give them a quote, they'd sign a contract with an NDA, they'd pay a fee, and then they'd give you all their data. You probably have a few meetings, maybe 4 meetings, and it takes 2 months, 3 months, 1 month.
Well, if you're talking about getting a what we call a deck or a confidential information memorandum prepared, it could be easily 6 to 8 weeks. By the time you get the data and you understand the data and you've had conversations with them and you put it, kind of mush it together into mathematical formulas, that's how long that process takes.
Okay. And just to be sure, I'm unpacking, this is my last question
that's all right.
on this topic. Let's just say that we have anyone watching it and they're like, I wonder what my company is valued at. I don't know if I'm ready to sell yet, in the sense that I don't know if someone would value it. Let's just say they're at the 2 to 3 year mark before they plan to sell, or they are literally ready to sell. Both of those types of potential sellers should reach out for, or could reach out for, evaluation and would find value in it, right?
Oh, absolutely. In fact, we would do that through our valuation company, and we counsel a lot of potential sellers, if they're a couple of years away, to actually get that initial valuation and then figure out a way to share in a compensation package with their management team, and then value it every year. And the management team can see what they've created in that year period, and they get more compensation out of it. So everybody is aligned and driving toward the highest possible value. So yes, we recommend strongly that if they're not ready, they're not on the market yet, get the initial valuation, because there are a lot of things you can do with it.
For people who have the ambition to sell it for as much as they want, you have to plan in advance, but you should get an expert, because you might think your value should be $1 million because your business is your baby and you spent your whole life building this thing. And most business owners, just like parents, love their baby and see the value of it and just think their baby's beautiful. But when you're coming to sell a business, an outsider is going to have a much more critical perspective, and you may not know what things they will not enjoy about your business. You might not know what criticisms they would have. So you might sell it for way less than you could if you pre-plan, get an expert to give you a critical perspective. And it comes with, their valuations can come with advice, like, oh, this is what you're missing 3 to 5 years from now. If you work on X, you can sell it for a different number. So that's an asset. So it's important for people to be thinking ahead. And I hope everyone listening heard that.
Well, like I said, and like you so clearly stated, a big part of our role initially is to find the problems and the advantages of the company, solve the problems, right, and emphasize the advantages.
What are the metrics used in this industry to create a fair market value? And I especially want to clarify, I need you to unpack things like EBITDA and how do you evaluate revenue and team and process? What are those words, and how do you use those things to value a company?
EBITDA stands for earnings before interest, depreciation, and amortization. A typical term used when valuing a business based on a multiple of EBITDA. So it's more akin to profitable businesses that have EBITDA versus a company that's flat, not profitable, maybe pre-bankruptcy, and that's typically based on net asset value, so assets minus liabilities, plus goodwill, which could also include IP. But once again, if there is no EBITDA, there is no multiple, so there's different metrics for that. And then as it relates to revenue, certain types of technology businesses that have high EBITDA margins are typically valued based on multiple of revenue. But I mean, you do the math, I mean, you still can kind of, you know, uh, quantify a multiple of EBITDA, right? So, but typically these tech businesses are valuing their businesses on a multiple of revenue.
So in terms of when you're using different metrics, those are two very strong metrics that are industry standards. And usually whether you use EBITDA or revenue to evaluate a company, it has to do with the industry that you're working in. So, hey, anyone watching this, if you have a business in one category, usually people value your company based on the same type of process they would value a similar company. But there's a few exceptions, and that's why you sometimes want a outsider to help you think of the best way to position your company. So if you position it in a different category, whether, for example, like a beauty skincare company, if you could position it as a software system because you have an app, it might get a different multiple. So it's important to maximize your total value. You want to think those things through. And it's especially important because some tech companies don't even have any profit in the beginning, but they have users. I think of BlackRock Coffee that recently sold, and it was sold for just millions of dollars, but they didn't have crazy, profitability at this point and even crazy revenue given how much they were selling for, but they had subscribers, loyal, regular, repeat buyers. And so they had an excellent team help articulate the value so that they could maximize, how much they're going to get. So is there
that's what Eric was mentioning, the recurring customers. There's a lot of value in the recurring customers. Let me add one other thing. We have this metric of EBITDA times a multiple, and that gives us a price. And that math allows us to have commonality of conversation, okay? But we do a lot of work on that EBITDA number because there are a lot of things that run through the company that really need to be added back. So when we end up with an EBITDA, it's an adjusted EBITDA, and it's the highest possible EBITDA for that seller.
There's the add backs, but there's also non-recurring events. So if the company is in, let's say, litigation and had to pay a $2 million settlement, that's a non-recurring event. So you want to take that into account on non-recurring events. Also, as we have lived in the pandemic for the last 2.5 years, a lot of companies have had a hockey stick growth in top line revenue because, for one reason or another, because of this non-recurring event. Now, granted, pandemics happen over decades, but that could effectively be a non-recurring event as it relates to the pandemic we've lived in the last 2.5 years. So we have to take that into consideration.
And you usually need someone to calculate that for you, be able to justify it for you, because whoever's buying a company will be evaluating, will have their own team of financially savvy people who are going to try to argue for the lowest value so that they can pay the least for a high value thing. So you need a team to eventually calculate those things for you and help explain why a valuation that you feel your company is worth it. So whether you hire Mentor Securities or someone else, you should just keep that in mind. You need smarties on your team to help you think of your own business from a different angle. Are there any other metrics that you guys wanted to bring up, either about team or process that you guys use in deciding fair valuation? You want to unpack it all for people?
Back to the professionalized management team. That's a bit more critical to have in place when a financial buyer makes an offer on the business, especially if they may not make a control investment. They may not do a full buyout. They may do a significant minority, call it 49%. So a professionalized managed team is very critical versus a strategic buyer. Now, a strategic buyer, they have their own we would assume that they have their own professionalized management team. Actually, it's to their benefit, right? They can adjust and leverage their current SG&A and meld the recently acquired business into their operations. But that's less important when it comes to a strategic buyer as it relates to professionalized management team. But it will help There is intrinsic value to have a professional management team because it costs money, right? So there's value in a professional management team to have in place.
I think this goes to another issue, Emily, that you've raised with us, and that is, what are the biggest hurdles that the seller faces? Because this is really heart and soul of that issue. Probably number one is that they're unprepared. Okay, so preparation is critical. Number two is, do they have enough of a strong management team, especially for that financial buyer, like a private equity firm that Eric's talking about, that can carry on the operations in the absence of the owner or the key people? That's what the buyers are looking for. Do they have depth in their management, in their middle management? Okay. I'll give you a quick story. A few years ago, we were selling a company, and a very strong company, nice EBITDA, but they were a mess in terms of who made decisions. And it was a kind of an autocratic owner, and he made most of the decisions. And he actually had a couple of his sons working in the business. So we sat down with him. We said, look, you need to create departments. You need to assign your sons and a couple other people to head up these departments. You need to work up the duties of what these people should be doing, call it doing, right? And we put this whole thing together as part of the management presentations when we had the final buyers come in and talk to this company. And they looked like they were, the org chart and the way they described their duties, they looked like they were so organized that controlling autocratic owner could walk away tomorrow and the company wouldn't miss a beat. But we had to do a lot of planning and a lot of work internally so that management team is critical to the value. Okay.
I think that's important for people to hear that, because everyone building a business it's usually an owner operator in the very beginning. You're the trash man and you're the salesperson and the star quarterback, as well as the coach. And it's difficult for emotionally to think about yourself not being in that business. You might think you want to sell it. You might think, I want to sell this business. But then when it really, the rubber hits the road, what it means is you have to imagine a world where you're not a part of it and build away from you being essential. And it takes a lot of strategy. It usually takes an outside eye, because an entrepreneur had to be so forceful to make this business succeed that imagine a world where they're not essential to it is I've seen it be difficult for some of my consulting clients. So it's smart to get an outside eye to help you strategize how to do that. So you're not also favoring yes men, people who just say yes. You want people who can lead the business when you're not there, so that it's an asset and can be sold for its greatest value.
Yep, exactly. I mean, the other thing, Eric mentioned customer concentration. We took on a company a few years ago. Their sole purpose, they did nearly $100 million in revenues. And their business model was that they found professional aerospace engineers. They did a certain amount of training, and then they moved those people into the aerospace companies as subcontractors. Okay. They did really well. And when we got down to a couple of the buyers, we started looking at where their revenues were coming from. And they were separate divisions. But when we added up all of the separate divisions of this one company, 87% of their volume was with Boeing, even though they had a lot of independent operations in Boeing that hired them. So they were hired all over the country, but until the question was asked in a different way, we didn't add up all those Boeing contracts. And to tell you the truth, we were not able to sell that company. And then this was before Boeing had the airplane problems. So the combination of that and Boeing not being the greatest company in the world at that point, that company never sold. And sometimes that happens. Yeah, sometimes it happens. Yeah.
And so customer concentration by definition is when you have too much of your revenue is coming from
in too few customers, right?
Customers, right?
Exactly.
Okay.
Yeah. It's another critical aspect of it.
Interesting.
The other thing is that you got to make sure that your financial records, your accounting records, your tax information ties out. Okay, we've seen situations where we walked in and the books are a mess. And Eric was talking about this before. They have really good systems and procedures in place. But I think, Emily, that's kind of that's an area where we could bring you in because you're great at process and at branding. So we need to think about you as well as you're thinking about us.
Yes, I appreciate you saying that. Yeah, for everyone watching, I do consulting, and everyone knows I'm very passionate about, the power of a sales process, for example, standard operating procedures for your sales process so that you're clear on where you're generating leads from, how you're closing those leads, the type of offers that you're making, so that it's not just, one of your salespeople or the owner making up a different sales scope every time. It needs to be something that belongs in a bucket so an outside person can repeat the sales process. Or with your brand, making sure there's a brand identity guide that if you sell this business, you have clear guidelines for how to use your brand, your logos, your fonts to repeat that on every different asset. And things like this, which seem very trivial, they seem like maybe a waste of time or investment. What's great about it is it turns, if you write things down, you have your profit and loss statement, your balance sheet, your standard operating procedures, your job descriptions, your brand assets, everything's clean and beautiful in a portfolio. Think about the confidence that you can create as a feeling for the person who's evaluating your company. They would look at the numbers and also be able to quickly evaluate, could I continue to make profit if I paid for this business? And you're going to create a feeling of confidence, an impression that this business is well thought out, and you will allow them to imagine themselves purchasing it. And sometimes sales is about numbers. That's the place we start. It's in the mind. But sometimes the highest value is about emotion. It truly is, because you have to convince a person that this is a worthwhile investment, that it's on its way up. I'm not just buying something that is worth X today and is going to be worth less tomorrow. They have to imagine a future and feel excited and passionate about it to pay a little bit more. And Eric gave a really funny example one time. We were out to dinner in Beverly Hills, and he was explaining that just a strategy that they had used to position a company. And just by sending a certain email and explaining the business in a certain way, they were able to get hundreds of thousands of dollars more for their client because of the strategy that Eric had implemented. And it wasn't because the company was worth more on paper. It's because there was a feeling that he generated by the email that was sent. And
Emily, that's a really, really good point, because today, buyers will do what they call a quality of earnings analysis. And this is another important thing. And as long as they see that the numbers tie together and they can track the revenues, they can track the profitability, you're 100% correct. If that's in focus and clean, then the buy is an emotional buy, right? It's that emotional attachment to the seller, because now I know that the issues are not there. They're clean. This company is strong.
Yes, and the organization of the process. I helped a company sell before, and when we did that, we created a portfolio book that had all of these assets so that you could kind of flip through it and quickly evaluate, oh, they've got their brand in place, they have their org chart in place. So these things, if you can just hold it in your hand, it's simple. If it's dumbed down so that it's simple and clear, the value, you're going to get a lot more.
Yes, for sure.
For it.
Yeah.
Okay, well, so it sounds like we have a good plan. We've discussed the plan to get everything ready. Let's pretend we've finished our valuation process. And Eric, I want to ask you, what is the sales process like? Once we're done with the valuation, we're ready to go. What are the steps that you would take us through, or to be able to sell?
It's very critical that the client, the selling company, is prepared. Clean set of books, also clear messaging by the holders or a majority shareholder as far as protocol, as it relates to who in the company knows that the company's for sale. There's got to be a playbook, or there's got to be a plan and protocol as it is initiated in the beginning as to what the process is and communications. Then we go through a due diligence process with the company to gain knowledge about the business. We usually set up a data room for prospective buyers to access once they've signed NDAs and, all the formality. We review the due diligence materials to understand the business. And we go through a Q&A process with the company after we have reviewed the due diligence materials. We certainly do, we either sometimes do site visits or in-person meetings with the client that we're selling their business. They may ask us to include various stakeholders and shareholders. It's up to them who they want us to include. And then we put together the market materials, the pitch decks, the SIMs, and put that all together. And then depending on what the client's requirement is, we prefer to do a rifle approach on a marketing process once we're ready to go to market. Some clients may want us to go to many people from a shotgun approach versus a rifle approach. And we also discuss timeline in the sale process with the clients to set expectations. There's a lot of clients that, how soon can you sell our business? I mean, we have this, one prospective client that is looking to do a bridge and says, well, he stated it's a 90-day process, but we can't wait 90 days. So it just depends how prepared the client is. And then once we go to market, we'll request indications of interest from prospective clients. We review those with the clients. We set up management meetings. We also set up a Q&A session after the prospective buyers have reviewed the materials. After NDA is signed, we'll go through a Q&A process. And then we'll go back out to those prospective buyers to determine who wants to issue LOIs. We'll review the LOIs with the client. We'll then go back to the prospective buyers and try to negotiate, the best price. And once we do that and we accept the LOI and our client accepts the LOI, then the prospective buyers go through their due diligence process. A deeper dive due diligence process. And once that all checks out okay by the buyer issues a purchase and sale agreement. We then negotiate the purchase and sale agreement and with the company and their counsel, and then execute and close.
Part of the magic of at least our process is that we try to get 3 to 5 really intense, interested buyers. And behind the scenes, we keep encouraging them. They've given us an indication of interest, which is usually, we've given them the EBITDA number because they haven't done their due diligence yet. So they have that number. They give us the multiple, okay, or maybe it's a revenue in a multiple, right? So we kind of know the pricing that they're thinking of. And a lot of them will actually come back to us and say, we're thinking of a multiple of 6 to 7. How's that sound? So it's this whole dance that we do at that point, because you see, when we put a seller on the market, we don't list. It's not like listing real estate. We don't put a price out there. Okay. We let the market dictate to us what the price is. However, if the price is not as high as we want, or we think we can leverage one buyer against the other, we might say, well, there's a couple buyers that are kind of right around that 8 multiple. Do you think you can push this up? And so it is a dance until you finally get to that ideal buyer, at least price-wise. But also, and this is part of the dance too, is when the management presentations are made, the seller really needs to be very, very acutely aware of who he thinks that his company will fit best with, because that's a critical component, right? Yes, cash is king, but so is culture. And that's a very important part when we do the management presentations and they share what the buyer's culture is, that there's a really good fit for our sellers.
especially if a person is an owner operator, or they're the ones who originally built the business. They didn't buy it from
Mhm.
someone else and then take it over. There is an emotional attachment to employees, the livelihood. You want it to continue, and you want it to continue in a way that is aligned with your original vision. So I think that's important to hear that, first of all, you guys value that and recognize it. And I think it's important for anyone who's selling to realize that it's not just about the money, because the person who buys it and feels, sees the culture fit will be able to pay more. So you want to be really self-aware of your own business and what the right buyer would look like. Two things that you said that I think I personally didn't know was that in the very beginning, you don't actually put a price like you do on a house. It doesn't say, hey, this house is $1 million, come buy me. You actually go through and the valuation process is incredibly important, because you come up with either the EBITDA or the revenue, which
Mhm.
is what's essential for the valuation. And then someone is actually bidding on the multiple.
Yes, that's what it means, right? It's just a math formula, right?
So if you have $3 million in EBITDA, which means kind of like, for those, again, if you're not familiar with it, you got to go Google it, because it is a little complicated, but it's basically kind of like the net profit when everything's
It's close. Yeah, it's
taken,
pre-tax, but it's close. Yeah.
taken into account. So let's say you did $3 million of net profit, essentially, approximately, then your potential buyer would say, I'll do 3 times that or 4 times that. And the average multiple they give, they would do comps saying, oh, this other, let's say you have a cookie company, 3 million in EBITDA, another cookie company was sold for 3 times their EBITDA. So that's what the buyer would do. They'd go research this with all of their team and say, I think it's fair to pay 3 times that. Or they
And
might
we've done our own research to back up what we think that multiple should be too. So we're both going at it, and we try to see if we come and converge together. Yeah.
So that's in the beginning phase. Once you've accepted an LOI, which I don't know exactly what that term means, but I'm assuming like letter of intent.
Letter of intent, yes.
Okay. So once you've accepted a letter of intent and they do that deep dive, do you ever come back and find that they try to negotiate on the number that you guys calculated? Is that ever on the table?
Yes, always. Honestly, they always try to come back and chip away. Maybe they analyze the EBITDA number differently than you do. So there's a discussion of that. They look at working capital differently than you do. They look at problems that maybe aren't really problems that we thought were advantages. They may turn it around and say, well, this is a problem for us. So yeah, they're always trying to nibble away, even though they've given you an indication of what they're going to pay. Now, the best situation is where this company is so strong and we presented it so well, and we've had a few of these where they don't nibble. So I say always they nibble, they nibble a little bit, but now they know that they're in a bidding contest with somebody else because there are a lot of people interested in this company. We had one where we had 30 parties interested, and the most difficult task we had, yes, was culling the 30 down to 3 to 5 buyers. It was amazing. And they kept bidding up the price. So I shouldn't say we always have them nibble, but that was an extreme example of an incredibly good company that everybody wanted. So they weren't going to nibble, but a lot of times they will nibble. Yeah.
Yeah. Well, in general, from a macro perspective, how long does the sale process typically take? I'm sure it depends on the type of company and how clear the sale is and how many people are interested, but could you give us a range?
I would say 6 to 9 months.
If it's a really good company, it should sell that quickly. It just depends. It could also take 12, 15 months too.
Right.
Because maybe well, it's more complex. Also the legalese, the lawyers are debating issues and reps and warranties. So you never know, but I mean, I think 6 to 15 months is probably a good broad range, if you will.
That's helpful for someone to keep in mind. So 3 months.
Right. It's not overnight.
3 months.
It's not overnight. Right. Exactly.
Yeah, so plan accordingly.
Yeah.
So then I want to ask, let's say we have these 3 to 5 people bidding on our company. How should you pick the best buyer?
Yeah, well, we have touched on that, and the culture and the cash, I think, are probably critical. We counsel the owner sellers, and it could be plural, as to how do they envision exiting the company? How long do they want to stay? So do they want to have an employment agreement that takes them for 2 years with the option that they could still, get out in 6 months if they don't like how things are being run because they're no longer making all the decisions? The other critical element is, do they want to roll over some equity? In other words, do they want to take a 20% interest in the new entity being the buyer, right? And so they get basically 75% of the purchase price, but they're still in the game. And so they have call it second bite of the apple. They have a chance to see that company continue to grow, and they're an equity holder so they can get something out of it. So there's a lot of different discussions that we have with the sellers in terms of the way they're looking at the buyers. And sometimes we see it a little differently. So we try to give a very honest perspective of what we're seeing from the buyers, and we respect the fact that the seller will give us their input. And so sometimes Eric's right. It's not always the cash. It's how does it fit afterward?
Right. Right. And the type of offer. So it's interesting. I don't know that many people stop and think about that, but it's good to also have counsel to make sure that you pick the right buyer to take over.
That's why you hire an investment bank.
Right.
And good advisors. We're very big on teams of excellent advisors, be they the tax accountant, the lawyer who does the M&A process with us, insurance agents to identify specific risks within a company, brand managers like yourself, Emily, that maybe can tweak a brand and make it much more visible, much more viable before the buyers have a chance to come into the process. So there's a lot of great advisors. A wealth manager, because the seller, once he's sold the company, needs to know what's going to happen with my money and how do I tax-wise keep as much as I can. And there's different strategies for that too.
Well, and that rolls right into my next question, which is, what are those issues that we might expect to face and challenges after it's sold? So let's say it's, everything you've described here will result in a successful sale. Mm-hmm. And once we've picked that buyer and it's sold, what issues might we face that we should kind of plan for?
You definitely want, I'm stating the obvious, but you definitely want to select a highly experienced RIA or wealth advisor, as they're known as. Is important to assist in growing the fruits of the owner's success after liquidity event, right? What do they do with all this cash? And they no longer have a cash flowing business support their lifestyle. So it's very, very critical to how they allocate that boatload of cash and how it's going to grow, and not only grow, but also generate cash flow for that, retired person or semi-retired person. The other important point is tax consequence, which is very, very critical. As they say, tax avoidance, not tax evasion. Right. So you want to have a highly experienced tax professional in place that gives you tax advice far enough in advance of a closing, and to determine whether a trust needs to be set up or some legal entity to set up as part of tax planning that needs to be completed far enough in advance of a deal closing. Because if you do it and I've seen this, that they haven't structured anything to mitigate their tax liability, obviously from a legal perspective. So that's really, really critical. And then, the other element is, transition planning. Do you have anything to add there, Davis, on transition?
Well, transition planning, one of the things we've seen clients do is take a certain amount of their shares and gift to a charity if they're charitably inclined, it's a good way to create a tax expense, if you will, or an expense against your estate. So we've seen people do different forms of gifting. We've worked with people who do different forms of installment sales. So there's a lot of current stuff in the marketplace that the sellers need to be aware of. Yeah.
And so those are transition payment plans. There's also the
Right.
transition of staff, the
Right.
training. So who will take over that new role? And you can hire someone to give you advice about that, but ideally you've planned that type of thing out in advance. For example, giving offers to your executive team so that they are motivated to stay
Right.
on board during the
Right.
transition. How are they going to be motivated? Well, maybe they get a piece of this new company or they get a bonus. So these things need to be negotiated.
Well, that's where I suggested early on that they value the business a couple of years ahead of time and maybe put in place an exec comp plan that allows the executives not only to see what value they've driven in the company, but participate to some extent. And they're part of the executive team and they know that they're going to be part of a sale. They're all working on the same sheet of music, and it's very, very important. Yeah.
Yeah, that's great. And there's so many moving parts. If you've never done it before, it's helpful to talk to someone else about it. You won't be able to come up with it on your own and anticipate all the challenges. So you got to write a plan.
That's right. Yeah.
So what are the biggest opportunities today for companies looking to sell? What categories are really succeeding? I'm sure anyone can reach out to you, but do you have any input on this?
Yeah, let me give you a few, and maybe Eric can add to the list. Consumer goods is always strong in almost any market. But today, software and SaaS companies, software as a service, which is a SaaS, very strong. Specialty engineering companies that are unique, maybe environmental engineering companies that are part of a roll-up. Veterinarian products are really hot now. Yeah. Let me give you a couple others. Subscription services. That's where you have those recurring revenues. Medical disposals is another area. Packaging companies. Surprisingly, military and government contracting is huge. And that's another big area that we've seen. So those are the ones that come to mind. Eric, you have any adds to that?
Yeah, I mean, I just wanted to expand a little bit on the packaging and container industries. There's been a huge uptick on sales and acquisitions of this within this sector. Mainly, that has been driving that is everything is becoming so e-commerce focused and less brick and mortar. So packaging is just a huge sector that has a huge uptick. We've seen quite a few deal closings in that space. The other is healthcare services, in which there is a recurring revenue. A good example of that would be, well, it's not maybe the best example, but one would be lab facilities like Quest, for example, is one of the biggest in the marketplace. So, healthcare related services is big too.
So if anyone is in those categories and you've been wondering, what they're telling you is this could be a right time for you. I would be curious to hear from you guys. Is there any other last minute best practices or pieces of advice, just to really, as a capstone piece of advice to anyone considering selling, that you'd like to tell us?
Well, first of all, hire you and then hire us.
Yeah. Good advice. Good advice. Get good experts on your team.
Yes, we want to be your experts. And we have a lot of fun with the process too. I think that's, it's interesting. We never talk about that. But while it's a very, very serious and detailed process, if you don't have fun with it and you don't enjoy it, it just makes it kind of onerous. And we kid each other and we have a lot of fun internally. I'll add one last thing. We've put together quite an executive team And we did this principally for our buy side clients, the private equity firms and the strategics. And so we have former CEOs, CFOs, and COOs in a lot of different industries. And we can always tap into our executive team for help if we're targeting certain, if we're on the buy side and targeting certain companies to find, or even on the sell side. And sometimes our executive team becomes part of the transition, Emily, because the buyer realizes their expertise is something that they didn't quite have internally. And so our executive team can transition over into the sold company, into the buyer's company. It can be very, very important. Gives us an edge. It's like our valuation expertise, our executive team, and the fact that we have fun.
Well, it is helpful to remember that, because I think that we talked about a good fit for a buyer.
Right.
When you're selling, you want to have a good chemistry there. You also should have a good chemistry with your advisors, because
Oh yeah,
they need to understand you. You need to like them and enjoy this process, because you're going to go through a little bit of a roller coaster.
you
And you
will.
want to be sure that you have a good advocate who cares about your best interest and who you feel resonates with you and really will help to advocate for you. So I think in terms of advice, what he's saying here is, hire great experts that you trust, that you like, that you find fun, who can give you the resources that you need. We also talked about planning in advance. Make sure that you are thinking 2 to 5 years out for planning your sale. And that brings me to this next, the last question that I want to ask you is, if someone is hearing this interview and feels maybe that Mentor Securities is the right person for them to possibly work with, do you want to just clarify who your best client is, or what the right fit for you guys is? Because there's lots of people out there who can handle very small businesses, very large businesses, and kind of just repeat the right customer for you, and how that person could reach out for you when they're ready to hire Mentor Securities.
Well, the easiest way is obviously to go to the website, and there's a form on the website that they could fill out. Or they can contact you directly, Emily, and you can put them in touch with us. The first part of the question was
who would be the right fit? Because I can
who
tell
would be
you,
the
I
right
have
fit?
some customers, for example, who don't have $3 million in EBITDA yet, and but they would like to sell. There may be, someone who's in the $1 million range. Because what I want people to understand is that
Right.
lots of different investment banks and M&A valuation companies, and you should go to one that is going to be a good fit for you. So,
Well, like we discussed before, we want to talk to that company that's $1 million in EBITDA, because probably what we'd start with would be an overall business valuation and identify the issues that are going to come up that they need to clean up to drive value upward. Okay. Whether it's having great intellectual property, or having a better management team, or whatever it is, or branding. Those are the types of things in the valuation process that we can identify. So yeah, no, we don't exclude those companies. We do a lot of valuations of companies that don't even have $1 million in EBITDA, that might be thinking down the road of selling.
Yeah, one thing that I wanted to add to layer on to what Davis mentioned about the $1 million EBITDA businesses, we get quite a bit of inbound inquiries from private equity groups that we have relationships with on an ongoing basis. Also strategics. So strategics are okay. They're okay looking at smaller businesses, including the PE. They're looking to make add-on acquisitions. So not so much critical as to there's got to be a minimum of 3 or 5 million of minimum EBITDA. So it's we'd rather look at the opportunity on an on the whim, and there could be a fit because we're in constant communication in the corporate world, and you never know. So we'd rather look at it and give you some input and possibly assist versus not even knowing about the opportunity.
Well, that's true. And it may be an industry where we've got special private equity firms that are actually looking for $1 million EBITDA company. So we might even decide if it's worthwhile and the client is okay of taking that client on. I mean, when we say 3 million of EBITDA, that's an ideal. 3 million and up, that's an ideal. but there's some really nice companies that do $1 million of EBITDA that could be sold. So Eric's right. We'll look at a lot of opportunities.
And oftentimes you want to have a relationship with someone even before you're ready. So let's just say
Yes.
you're going to do it in 8 years, 5 years. Like, why not reach out, make a relationship, an introduction, kind of get a preliminary idea whether or not it's a good fit right now or not.
Right.
And then you maybe, a couple of years down the road, and I've written growth plans with clients before. We said, okay, in 8 years, they will take on venture capital money. And the plan that we wrote, they followed it exactly. And it literally happened because they had a lot of work to do. They were in a different position.
Right.
They weren't ready
Right.
for sale. And I've worked with other clients where they were ready to sell within 2 years, and we wrote a plan and they followed it, and they were ready to come and talk
And
about
we help a lot of companies, like Eric was mentioning, even smaller companies, with that exit plan, and bring in experts like yourself, because they need to be surrounded by different experts that will clean up certain areas of the business. And it's all about driving value in the eye of the buyer. That's all it is at the end of the day.
Man, that's a beautiful capstone to close out our video, because we always talk about going from start to sold, and it's the value to the end user that we always want to be communicating, whether it's doing a day-to-day sale or selling our entire company. So I appreciate that you closed with that. Very well done. We didn't even coordinate that. So for everyone watching, just thank you guys for your time. I want to thank you, Davis and Eric, for joining us today.
Thank you. We appreciate it. Okay.
Yeah, and everyone feel free to reach out. You can even add Eric and Davis on LinkedIn just to follow their articles and open a relationship if you want. Or if you're interested in following up, go to mentorsecurities.com to read more about them and peruse and snoop. And you can also leave questions in the comments. We welcome that. We'd love to hear what other things you were confused about, what part you absolutely loved, and what other things you'd like to learn about more in the future. So thank you, everyone. I hope this helped you to go from start to sold.